Trust me, I get it. You're looking to fund your business, but you're not sure what is the best option. I'm going to break this down right now. I'm Stephen Waiters, owner and CEO of Waiters Capital. To this day, we have funded over $24 million to small and medium-sized businesses, and this is what we do on a day-to-day basis. Let's get started. For my more established business owners, I will always say SBA. SBA is usually the best product for your business, depending on what type of business you have, and here's why. SBAs are simply government-backed loans. What does that mean? A bank is giving you a loan, but the government is backing it. Therefore, the bank is more lenient on approving you and also having a better interest rate on that loan as well. SBAs are for more established business owners, so you want to be in business for at least 2 years to qualify for SBA. The minimum revenue that you want to have when applying for an SBA is about $120,000 a year, which is simply just $10K a month in revenue, right? You want to have at minimum a 640 credit score to qualify for SBA. I'm gonna go even deeper when it comes to SBA. So at SBA, you have the SBA 7A, the SBA 504, and the SBA Express or Streamline program. The SBA Streamline program is typically the quickest turnaround. You can qualify for up to $150,000. The only docs you need to provide is 6 months of business bank statements, 1 year personal tax returns, and 2 years of business tax returns. If you have those, you can qualify right away. When it comes to SBA 7A, they can lend you up to $5 million, but that's going to be a full doc process, meaning that they're going to want to see profit and loss statements, debt schedule, 2 years of personal tax returns, 2 years of business tax returns, 6 months of business bank statement. They want to see everything. So that can be a longer process depending on how much you're looking for when it comes to SBA 7A. SBA 504 is more so for business acquisition. So for those looking to acquire a business or some type of real estate, SBA 504 is ideal for that. Moving over, we're going to skip credit cards and go to revenue-based lending. All right, moving on to one of my favorite products, revenue-based lending. Revenue-based lending is various types of products. It's merchant cash advances, business lines of credit, sometimes even equipment financing as well. I'll explain how all of these work. So with revenue-based lending, they're able to lend to you based off the revenue in your business rather than your credit score. If you're watching this, you probably understand how important credit is. And usually for traditional banks like a Chase, Wells Fargo, or your local credit unions, they want to see a good credit score before they want to lend to you. For business owners that have challenged credit, revenue-based lending will probably be your best option. Why? They fund very quick. Within 24 to 72 hours, they can fund you. All they want to see is 4 months of business bank statements to verify income. You must have a business bank account as well to qualify. And like I said, if you're about at 10K a month minimum, depending on your industry, more than likely you'll be approved for some type of lending. They lend to business owners with as low as a 500 credit score. Why is this valuable? It's quick funding. These deals close quick. This is private lending, so it's not coming from a traditional banks. With traditional banks, sometimes it takes a longer time to get approved for business loans or business lines of credit, and there's a ton of underwriting that goes into play. They want to see how much money you're making, your credit score, and if your credit score is not good, you more than likely won't be approved. But with revenue-based lending, like I said, they're more relationship-based, and this can help a lot of business owners that need quick funding to help build their business. Keep in mind that sometimes revenue-based lending is higher interest. The lower the credit score, the more expensive it's going to cost you to borrow money. That's just how America is, right? If you have a 750 credit score, you can probably find a decent interest rate on a business loan product, right? But when you have a 500, 550, it's going to be more expensive when it comes to you borrowing money, because to lenders you seem risky because of your credit score. That's why if your credit is not in order, definitely recommend getting that fixed so they can qualify for better terms. Last but not least, I did not forget my startups, right? Let's say you're a business owner, you say, yo, Stead, I don't have any docs. I just started my business. We haven't been making money like that. And I understand how hard it is to start a business from scratch. There are products out there for you if you have a good credit score, right? I recommend credit cards 24/7. The reason why I recommend credit cards and why they're best for startups, usually to qualify for credit cards, you don't need documentation for most banks. They'll approve you based off of stated income or something similar like that. So you can kind of get away, and they're willing to work with you depending on what type of industry that you're in and what experience you have, right? Another great thing about credit cards that a lot of people overlook is the 0% interest entry rate that you get with a lot of these credit cards. Not every credit card offers them, but there are a ton that do, especially from national banks. 0% interest APR credit cards for the next 12 months, 18 months. You essentially have a 0% interest loan for the next year, year and a half. What does that mean? Whatever you spend on that credit card, you only have to make the minimum payment a month. You do not have to pay anything else right then and there, and you're not hit with interest. Why is that valuable? As a startup, I understand how much money you got to kick out just to get going. What you don't want is something high interest where you're just starting the business, you haven't been making money yet, and now you got to pay back all this interest. So 0% interest credit cards are really the way to go when it comes to that. I know you may say, yo, Stead, I'm in real estate, I'm in whatever. I can't use credit cards for my business. There are ways to actually liquidate those credit cards. If you want to learn more, send me a message and I'll introduce you guys to my liquidation partner as well. The savvy thing about credit cards that a lot of people don't understand, that you typically just need a 700 plus credit score to qualify for funding. As long as you have a 700 plus, I don't know everybody's credit report, but typically when you have a 700 plus, you typically can qualify for some type of funding off of stated income and not having to provide financials. And this is why this is best for startups. On top of earning reward points. I travel for free everywhere I go, not because I just know people at these hotels or airlines. It's because I got credit card points. Every business owner has business expenses. You use your business credit cards to pay your business expenses. You accumulate points and you can redeem those for a cashback, free travel, and different things like that. So honestly, my favorite product out of everything is business credit cards, simply because of the 0% interest, but also the credit card points that you can redeem for travel and cash back. Well, this wraps up this video. If you want to learn more about business funding, make sure you subscribe. See you in the next one.